welcome. You're watching the Money Control Show. I'm Sakshi Batra and this is where we talk about macros, markets and money. On the show today, we will talk about negative interest rates and their impact on investors. We'll also discuss about the RBI surplus funds transfer to the government and its implications. And we'll get you insights into the stock markets and the cues you need to watch out for in the coming week. In a normal scenario, which we all are aware of, the borrower pays interest to the bank on the loans that they get, and the bank pays interest to the depositors for parking their money with them. That logic has been turned on its head in some countries, especially in European countries. And this is the era of negative interest rates, where the bank has started to pay interest to the borrowers and is taking away interest from depositors. Money Control's personal finance editor, Kayezad Adajania, is in conversation with Joydeep Sen, a financial planner and founder of wiseinvestor.in, to discuss about this in more detail. Let's go across to listen in. Over to you, Kayezad.
Thank you, Sakshi. Hi, Joydeep, and welcome to our show again. Let's start with asking you the very basic question. We've heard about negative yields, we've heard about negative interest rates. So, what's the difference between yield and interest rate? And, why are we seeing negative yields and negative interest rates in some European countries?
Okay, so two very different issues. First, let's say what is negative yield and negative interest rate. So, interest rate means if you, let's say, put money in a bank FD, you get an interest rate, say for example 7%. That's okay. Simple and straightforward. Now, what is yield? Yield is your annualized return which you get on a bond, for example. Just to give an example, if you have a bond of a coupon of say 7%, you buy the bond for 100 rupees, you get 7% yield, annualized return.
Okay.
If you buy the bond for 110 rupees as an example, you get less than 7%.
Okay.
Same bond, if you buy at say 90 rupees, you get more than 7%.
Correct.
That's the concept.
Correct. So basically, it's the yield is basically the return that you make on your investment.
Yes.
And the interest is just the printed coupon that comes along with the
exactly. Exactly.
Instrument.
In fact, coupon itself means the annualized payments given to you.
Okay.
So your purchase price defines your effective return over the holding period.
I see. Okay.
Now coming to your basic question as to why things are negative in certain countries all over the world. Yeah. If we go back say 10, 11 years, the global financial crisis or the so-called Lehman crisis, what happened after that? Okay. Central banks all over the world, US, Eurozone, Japan, they cut interest rates and they pumped huge amount of liquidity, as in huge amount of money. Just to give a perspective on how much of money, just imagine if central banks were to pump $1 million per day since the birth of Christ. If you do the mathematics, 2019 into 365 into $1 million, that comes to less than $1 trillion. The amount of money pumped in, as per estimates, is $7 to $9 trillion. That's a huge amount of money. So where does the money go?
That's been pumped in since the global financial crisis.
Yes, over the last 10, 11 years. So where does the money go? The money has to buy something. Money can buy equities, money can buy bonds, money can buy other assets. Now what's happening, bonds is like we just said, a 100 rupees bond, if you buy for more than 100 rupees, your yield is less than 7% in a 7% coupon bond. That is what is happening. Equity markets are generally buoyant apart from some recent correction. So in the bond market, if a German bond, say for example, they call it Bund, let's say a 2% coupon German Bund. If you buy the same 10-year bond at say for example 130 rupees per 100, your yield is negative. That is what is happening. So much of liquidity chasing a given supply of financial assets.
So the yields have been also now negative. The interest rates have been negative, but the yields have also been negative. So is that some kind of a sign that there's going to be recession in the future, or people are negative about the long-term state of the European economies?
Yeah. So to clarify here, in the US, the rate is 2.25%. Rate means the US Fed defined overnight rate. In the Eurozone, the overnight rate, which is equivalent of our RBI repo rate of 5.4%, the equivalent is actually zero, not negative. So the equivalent of our RBI reverse repo rate, which here is 5.15%, in Eurozone it is minus 0.4%, and in Japan it is minus 0.1%. So these are the central bank administered interest rates. Now coming to yield, estimates are globally $16 trillion, which is approximately 35% of outstanding stock of government securities globally is in negative yield.
Negative. Okay.
Which means even if the bond carries a 2% coupon, given the price of 120, 130 or 140 rupees, effectively your yield is negative.
Okay.
So what does that mean? As you said, it means a recession may be forthcoming.
Okay.
So as per expert estimates, there is a 30 to 35% probability of a recession coming.
Okay. I see.
And just to clarify here, what is the definition of recession? The definition of is 2 consecutive quarters of negative growth.
Okay. Okay. So I'm going to go back again to negative interest rates. We've been hearing a lot of examples in the European countries where depositors, when they deposit money in the bank, they have to pay the money to the bank, and it's the other way around. When you want to borrow money from the bank, instead of paying interest to the bank actually pays interest to you. So isn't the whole logic is sort of turned onto its head. Isn't it a loss-making proposition for the bank in this case?
Yeah. So strange things are happening in the world, but it is not as prevalent. Okay. So as I said, in the Eurozone, the central bank administered overnight rate is actually 0, not negative.
Okay.
So the recent case was, this Jyske Bank, not Hindi Jyske, but Danish Jyske, Jyske Bank, they offered a product with allegedly negative interest rate, which means allegedly they are paying you to take money from them.
Yes.
But the reality is, if you look into the intricacies, they have certain, charges.
Okay.
So effectively, per 100, you end up paying more than 100, even though it is apparently negative interest rates.
Okay.
So in a normal situation, even today, even in the Eurozone, if you keep money with a bank, you tend to get more towards 0 than towards negative.
Okay.
And if you take a loan, the rate is more towards positive than negative. But yes, strange things have started happening. Just to give an example, recently in Germany, there was a long-term bond issuance, government bond issuance, with a defined negative yield.
Defined negative.
Yes, and they got 40% response, as in 40% of the subscription. Next day, the price went up, as in the yield went deeper into negative.
Okay.
So these strange things are happening in the world now.
Okay. Okay. So closer home domestically, do you see some of these things happening over here? Do you see the interest rates and negative yields, negative interest rates over here also?
No. Answer is no.
Okay.
The reason is, India, we are a growing economy.
Okay.
Our fundamentals are different, our interest rates are different, and our inflation also is different.
Okay.
Just to tell you something basic, what is interest rate? It is the cost of money.
Correct.
So as a growing country, we need money, which means somebody who wants money has to pay the cost of that money.
Okay.
Just to give an analogy, an adolescent person gains height faster, whereas a person in 20s or 30s does not gain height at that rate. That is the thing in India. So as a growing economy, we are structurally much different than the advanced economies of, say, Europe or US or Japan. So that thing will not happen in India.
So Joydeep, what's the impact of negative interest rates and negative yields on Indian markets?
So impact is there, but limited. Let me clarify why. It may seem that globally nowadays markets being interconnected, something happening any part of the world happens and impacts any other part of the world.
Yeah, that's true.
Which is true. But why is it limited in India? The reason is, if you look at the holding pattern of securities, there are limits, and the extent of holding of FIIs of government securities in India is only 3 to 4%.
Okay.
And if we add corporate bonds, the holding is only 4 to 5%, which means the impact on markets is there but limited. Secondly, impact is there on RBI policies.
Okay.
So RBI frames policies on interest rates,
Correct.
depending on various factors like inflation, like GDP growth, including interest rates abroad.
Okay.
So there is an impact, or should I say sentimental impact, of interest rates abroad, which is negative now, on RBI policy formulation.
Okay. Okay. And finally, Joydeep, what's the impact on the equity markets? Because you earlier said that so much of money is chasing, borrowers are disincentivized, rather incentivized to borrow money. Depositors are disincentivized to put money in the bank. So when so much money is outside in the hands of the public, does it find its way into the stock markets?
Yes, it does. So what is happening is, so much of money chasing financial assets. So price of those assets are going up. So in the equity market globally, barring some recent correction, markets have gone up. So what it means is, in a way, the equity market is ignoring the signal given by the bond market.
Okay.
So in the bond market, there is a 30%, 35% probability of a recession.
Okay.
So the equity market is ignoring that, and the equity market is generally going up, which means the equity market is signaling a bright future ahead of the global economies.
Okay. Okay. Thank you, Joydeep, for your insights. Over to you, Sakshi.
Thanks a lot, Kayezad and Joydeep, for that very insightful discussion on negative interest rates. Moving on, the Reserve Bank of India on Monday approved a record 1.76 lakh crore rupees payout to the government after the RBI Central Board accepted the Bimal Jalan panel recommendations. Watch this insight to know more. Earlier this week, the Reserve Bank of India said it will transfer 1.76 lakh crore rupees to the government, with about 1.23 lakh crore rupees being its surplus for 2018-19 and another 52,637 crore rupees of excess provisions identified by the Bimal Jalan panel. The surplus is simply RBI's terminology for profits. Now, how does the RBI earn a profit? The RBI earns an income from interest on its bond holdings, deposits in foreign banks, and earnings from buying and selling bonds. It deducts its expenditure mainly for printing currency notes and maintaining its operations to generate a surplus. This surplus is generally transferred to the government as a dividend. In some years, RBI also sets aside money for a contingency fund. This fund is meant for meeting unexpected and unforeseen contingencies, such as a rapid depreciation in the value of securities the RBI holds, risks from exchange rate policy operations, etc., or risks from an unexpected event like demonetization. The contingency fund, along with the other RBI reserves, forms an important part of the RBI's balance sheet. They add to the RBI's arsenal to meet unexpected disruptions and provide comfort and confidence to global investors. It has been the government's contention that the RBI holds excessive capital, that it needs not hold so much money in its reserve. After the new Governor Shaktikanta Das took over, he constituted a committee under former Governor Bimal Jalan to study this issue. The Jalan panel has recommended a level for central bank reserves, keeping in mind RBI's public policy role and the risks it manages. On applying the level to this year's balance sheet, it was found that RBI carried excess provisions of 52,637 crore rupees, which has then been transferred to the government. The Reserve Bank of India on Monday approved a record 1.76 lakh crore rupees payout to the government after the RBI Central Board accepted the Bimal Jalan panel recommendations. Now, this whole week, there have been innumerable debates to understand the math behind the transfer of this fund to the government. And in this particular segment today, we will focus on finding out if this fund will help the government really reduce the financial stress on the economy and also its impact on the bond and equity markets. Ravi Krishnan joins in to share his insight. Welcome to the show, Ravi. It's great to have you with us. Well, before Ravi, I begin to understand and asking you about the implications for the benefit of all our viewers, could you please help us understand with the context first as to why is the RBI giving this excess reserves to the government, and is it a periodic exercise?
Well, there are two parts to the transfer of the rupees 1.76 lakh crore which was announced. One is a regular transfer of rupees 1.23 lakh crore. That's a dividend which RBI gives every year to the government. The second is a rupees 52,000 odd crore, which is being made because the Jalan panel has recommended that the RBI's contingency funds should range between 5.5 and 6.5% of its assets. On applying the 5.5% limit, it was found that the RBI was carrying excess reserves, which has now been given to the government. Now, coming to the second part of your question, it is likely to be a one-off exercise for at least the next few years. From the next year onwards, if the RBI's contingency fund is in this range of 5.5 to 6.5% or even slightly above it, although that appears unlikely, the RBI's whole surplus will be transferred to the government. But there will be no reserve write back or transfers from these reserves. The Jalan committee has recommended that these limits be reviewed every 5 years. So we shall see then.
So, Ravi, is the current amount of transfer according to expectations?
Well, Sakshi, it depends on whose expectations and again which part of the transfer you are referring to. As I mentioned, the rupees 1.23 lakh crore is slightly above expectation by around 5,000 crore in my reckoning. But the 52,600 crore transfer from the excess reserves, that is clearly a windfall for the government. However, remember that some people were saying that the RBI was carrying excess reserves of 2 and 3 lakh crores, by looking at the size of the RBI's balance sheet. That clearly has not happened.
So Ravi, are there also indications of similar surplus transfers to the government even next year?
Well, that's hard to say, Sakshi. It depends on a lot of factors. One reason why the RBI was able to achieve a high surplus in the just-ended fiscal was a massive bond purchases it had done. But remember one thing, the contingency fund is at its lower limit of 5.5% of assets. Assuming balance sheet growth of 7.7%, that's the average growth seen in the past 9 years, the RBI would need to set aside close to rupees 17,000 crore to maintain this at the minimum level. I should caveat this, these are rough calculations as of now.
And Ravi, how will this money be really given to the government and transferred to the government?
Well, to put it simply, the money will be transferred from RBI's reserves to the government deposits with the RBI. Now, this is an accounting entry. What will really happen is that as the government starts spending this money, this would increase the currency in circulation. So, essentially the RBI is printing money.
Right. Now also help us understand, Ravi, what will this mean for the RBI? I mean, will this weaken the RBI's balance sheet at all?
Well, Sakshi, if the rupees 52,637 crore provision had remained in the RBI's balance sheet, the balance sheet would have been stronger to that extent. That said, the Jalan committee has studied all the risks and come out with a framework. The panel believes that its recommended level of capital is sufficient for RBI to meet any contingent requirement. It is good to have a rule-based system to decide the level of economic capital that the central bank should hold. Of course, this can also change. But importantly, the panel has said that any surplus transfer to the government must be paid only from retained earnings and not by using the notional revaluation reserves. These revaluation reserves form around 18% of RBI's balance sheet, and that's where the rupees 3 lakh crore figure which I had mentioned earlier comes from.
Now, Ravi, a lot of critics have been actually pointing out that this is not the right time for the transfer of these reserves because the economy is weak and there are a whole lot of risks as well. So what are your thoughts on that?
Well, Sakshi, yes, the RBI could have done one thing. See, these contingent reserves formed around 6.8% of its balance sheet as of 2018-19. They could have gradually allowed it to settle at the lower limit of 5.5%. All the RBI needed to do was to transfer the full net income to the government, and as the balance sheet size grew, the proportion of these contingent reserves would have automatically fallen to 5.5%. But that said, we should also remember that the government badly needs this money now.
So is it a windfall for the government really?
Precisely. It's a welcome bonanza. See, given the current evidence, the government will find it difficult to meet the current fiscal deficit target of 3.3% of GDP without cutting spending. See, because revenue collections have been weak. In the first quarter of the current financial year, gross tax revenues of the central government rose a mere 1.36% from a year ago. That's far short of the projected increase of around 18%, which the government projected in the budget. See, the prognosis is also not good. Kotak Institutional Equities, if I remember correctly, estimated that the shortfall in the goods and services tax is around 1.5 lakh crore for 2019-20 already. With growth slowing, the pressures on revenue collections will only increase, and this bonanza will help.
And Ravi, what does this transfer really mean for markets and liquidity?
Well, Sakshi, we saw that how bond yields fell after the announcement of this transfer. The main worry for the bond market is that the government will not be able to meet the fiscal deficit target because of poor tax collections. So this fiscal bonanza will go some way in assuaging their concerns. All said, the bond markets would welcome the government using this fiscal windfall to meet the fiscal deficit instead of starting some kind of spending program. If the government remains prudent, bond yields could fall even more because more rate cuts are expected from the Reserve Bank. Projected consumer price inflation is below the 4% target, which will aid the rate cut. This transfer will also add to system liquidity. System liquidity is already in a surplus, as we know, so this will add to that. That in turn will aid the transmission of policy rate cuts by the central bank. In other words, you can expect lending rates to fall.
Thanks a lot, Ravi, for sharing all those thoughts there and helping our viewers really make sense of what this whole surplus transfer is all about and its impact as well. Well, the lending rates also easing will be definitely good news for the consumers going forward. Moving on to markets now, Kshitij Anand, markets editor at Moneycontrol, joins in with all the action in the stock markets and cues for the week ahead. Thanks a lot, Kshitij, for joining in. Well, it was the expiry week this time around, Kshitij. So how did the markets really perform?
Well, Sakshi, it was indeed a volatile week for Indian markets. We started the week on a very strong note. Sensex rallied by around about 700 odd points. Nifty 50 also saw an uptick of 200 odd points, which helped the index gain above 11,100 levels. But the momentum sort of fizzled out in the middle of the week, and especially on the expiry day, Nifty 50 actually, or Nifty futures, closed the week with loss of more than 2%. In fact, for Nifty, it was 2.7%. If you look at the rollover activity, Nifty future rollover stood at 68% for the September series compared to 3-month average of 75%. Now, most experts feel that most of the short positions got rolled over in towards the September series. So definitely we could see some bit of pressure on the markets as we move into September. Now, apart from that, if you look at the crucial resistance level to watch out for, that will be 11,200. Now, coincidentally, that is also the 200 days moving average. Experts feel that as long as Nifty is trading below this level, there are higher chances that bears would again take control, but a move above 11,200 could take the index towards 11,400 and 11,500. On the downside, supports are placed at 10,757. Apart from that, 10,756, 10,636, as well as 10,500 levels.
Well, Kshitij, there was also a whole lot of news for the markets to digest this time around. First, the FM announcements on the rollback of FPI surcharge, then the RBI surplus transfer, as well as the relaxation in FDI norms. So how did the markets react to all of these news?
Well, actually, the measures introduced by the government or the finance minister, in the week gone by definitely are steps taken in the right direction, right from rollback of higher tax surcharge for foreign portfolio investors or to tweaking FDI norms. But then again, much of the selling that we saw on D Street largely could be attributed to global cues. We are seeing some bit of fears about recession. Trade war is escalating at this point in time. Apart from that, rupee also depreciated slightly against the US dollar. In fact, it breached 72 rupees per US dollar mark. So all these things could be attributed to more of global cues, although government has taken the steps in the right direction at this point in time to really boost consumer and investor sentiment. In the past 5 or 6 trading session or since last Friday, FPIs have actually sold more than or around about 4,000 odd crores in Indian equity market. So at this point in time, I think the mood is slightly cautious, but that is largely to do with global cues.
All right, Kshitij, then what are the big cues and triggers to watch out for in the coming week?
Well, actually, come Tuesday morning, markets will react to GDP numbers for June quarter. Apart from that, infrastructure output data for the month of July as well. They will also react to auto numbers, which will start declaring their sales data for the month of August on 1st of September. That's over the weekend. Now, remember, on Monday, markets will remain shut on account of Ganesh Chaturthi. So markets will react to all these macro data on Tuesday morning itself.
Thanks a lot, Kshitij, for sharing with us all those details. And with that, it's also a wrap here on the Money Control Show. But you can catch up on all the news from the world of business and finance on our digital platform, moneycontrol.com. Many thanks for tuning in.